So welcome to Learning Objective 2. And this is an important objective because it starts to introduce you to terms that we use in accounting all the time, and that you're going to be using all the time throughout the rest of the course. And actually, as long as you're a business major, you're going to be using these terms. So it's good to know some of these. This explains and introduces you to what they consider the three principal types of activities that businesses engage in. And they sort of classified it around these particular activities. The first one being something called financing activities. Now, you might actually, I think you're all sort of familiar with financing activities, whether you realize it or not, because financing activities happen to everybody, not just corporations. And it works something like this. You want to go ahead and purchase a vehicle, for example, you want to buy a car. And then the dealer will ask you, how are you going to finance this car? In other words, what the dealer is saying is, where are you getting the money to make the purchase of this car? And so financing activities are really about where businesses get money to buy the things they need to do business. So finance activities are really about that. You'll see that first and foremost on the next slide. The next type of activity that's introduced to you is something called an investing activity. And I need you to take your personal financial shoes off because every time we hear about investing activities, people are like, oh yeah, I like the stock market and stocks, bonds, mutual funds, all that shit. Yeah. Well, we have to put that thinking aside. I need you to put your corporate shoes on. Might be a little bit shinier, maybe a little bit pointier, but nonetheless, they're corporate shoes. And investing activities in this case means, we need to purchase what we call resources in order to get business done. So, for example, if I have a pizzeria, a small pizza shop locally here in Wappingers. Well, one thing that if I did need money and I need an investing activity, what I would want to do is make sure I could sell more pizza and more sandwiches and other things that I sell. So that might mean investing in a new oven where the ovens can cook pizzas and sandwiches more rapidly. Thus, I can sell more pizza and more sandwiches. Or I might invest in a delivery truck. So not only am I able to make those pizzas and sandwiches much quicker, now I can deliver all of those, and that will help me sell more of my stuff. So investing activities are really activities that businesses buy resources to help them sell more of their goods or services. And you'll see more about that. Operating activities are the last one, and operating activities are basically all the business activity that happens when the business is open. The word operating in this case is the hours of operation. When is the business open and operating? So some businesses actually have pretty standard operating hours. They might start at 8 o'clock in the morning and open their store, and they're not going to close until 10 or 11 at night. So those would be considered the operating hours. And so any type of business activity that happens during those hours are normally classified as operating activities. And you'll see specific details about that in this part of the chapter. So those are the three types that we're going to be looking at today. We're going to start with financing, move to investing activities, and then operating activities. The purpose of accounting is to make sure we keep track of all that stuff. Okay, it's very important that we have a tracking system so we can look at everything that's going on. Okay, first and foremost, financing activities. Like I said, the finance activities is something that's pretty practical. Where you want to buy something, and businesses, they might want to buy buildings, they might need to buy equipment, they might need to buy other types of things. Where are they going to get the money to buy it? So that's a financing activity question. Okay. And usually when you want to buy something or a business wants to buy something, there's actually two ways in which you can do so. You're either going to borrow the money to buy something, and that's very common use of debt. The whole purpose of actually taking on debt, for the most part, is to purchase something. So businesses would borrow money to buy equipment. Businesses would borrow money to expand and put up new buildings, more stores, for example. That's a reasonable use of debt. Okay. Another way that they would get money to buy those, buy that new equipment or buy and open up new stores is to ask their owners to put the money in to use, and that's what's called equity. Okay. So what we're looking at here are two ways in which everybody, and you're included, how you get money. You can either have the money yourself and buy something, that's your equity, or you can borrow money. So let's say you go buy a car, say it's a used car, it's a $10,000 used car. You need $10,000 of financing to buy a $10,000 used car. It's pretty simple. So how you finance that? Well, you might have a couple of $1,000s that you're going to put down on the car. That's your equity. But you might need an $8,000 loan to buy that car. That's your debt. Okay. So finance activities looks at where we get money to buy those things. Now, specific terms that you need to become familiar with. Liabilities is a very important accounting term. And liabilities really look at, and they're classified as or defined as amounts that are owed to others. Those are liabilities. If you owe something to someone else, a creditor, for example, someone who loaned you money, that's a liability. That's a liability. Businesses will borrow money both for short periods of time and long periods of time, depending on what they're purchasing or what their needs are. So you're going to come up and you're going to learn a couple of specific accounts now. One liability account is something called a notes payable. And this is important to note. Yes, there is a pun there. Note in accounting means loan. Okay, so every time you see the word notes in accounting, it's simply a loan. Most notes are short term, and in accounting, short term is anything less than a year. So it might be a 6-month loan or a year loan. Sometimes notes can go more than a year and a half, 2 years, so forth. But most notes are short term. So a notes payable is a type of an account in accounting that would fall under the classification of a liability because it shows that we owe money to somebody. Bonds payable is another. The word bond is very important to understand. A bond is also a loan, but a bond is a loan from investors. Okay. A lot of people are very familiar with the stock market because it's in the news almost every day. But what's very important to understand is the stock market's only one place investors can go to make investments, and their investments there are ownership. Some investors are not interested in owning; they just want to lend and make money by lending. So investors would go to the bond market. The bond market is the lending market for investors. And corporations are a large part of the bond market. So are federal and state governments as well. But here we're looking at it very specifically here. So a bond is a loan from investors, and these are long-term loans. And what we mean in this case, 10 years, 20 years, and in some cases up to 30 years. Bonds are very, very long-term loans by investors. Okay. So here you have two specific accounts that we classify in accounting as liabilities. So liabilities is sort of a general big term. Any amount that's owed is a liability. A note is a specific liability. A bond is a specific liability. So there you have your first foray into accounting. Woohoo! Are you excited? I can tell. I can't see anybody, but I can tell you're excited because you're learning accounting now. Woo. Yes, this is a Dear Diary day. All right. The second thing here is when you can finance by borrowing money from others. You don't have to go to a bank all the time, although it is, a common place to go. Again, you can go to investors. Well, investors are also interested in ownership. And ownership of corporations is possible if the public is able to purchase shares of ownership on a public market, like the New York Stock Exchange like the NASDAQ exchange, et cetera. So anytime you see a company that has shares of stock that you can buy, that's called a public corporation. And that means they raise money by selling ownership, shares of ownership to the public in exchange for the cash that we're investing in. So that's important to note because corporations are broken into shares of ownership. Those shares of ownership are called stock. So stock and shares basically are interchangeable terms. You can pull them out of a hat, they mean the same thing. Okay. Um, and so that's another thing. Ownership is important. Ownership in a business is called equity. For small businesses like sole proprietors and partnerships, it's simply called owner's equity. But in a corporation, the owners are stockholders. And so in a corporation, it's called stockholders' equity. Okay. So stockholders' equity simply represents the share of ownership that the owners have in the business. That's it. What they do purchase is what we call common stock, which is this common ownership, common shares of ownership. And that's basically what they get. They invest cash. What they get in exchange for that cash is common stock, which is legitimate ownership shares in a corporation. Sometimes businesses will share some of their earnings with their owners. And that happens when the business gets established and is a little bit older and mature, and doesn't need as much money to run and invest in itself. So when a company actually gets to be a little bit more mature and they're making good money, they like to share some of that profit with the owners, and that's basically what a dividend is. And a dividend is another, just like common stock, it's another specific account we talk about in accounting. So two more specific accounts that you're learning about, and another type of general, what we call stockholders' equity. You are just in for it today. You didn't know your Tuesday was going to start this good, but it does. So here we go. The next type of activity, as we talked about or introduced a couple of slides ago, was an investing activity. And again, we have to look at it from a corporate perspective. It doesn't do Walmart much good. If you look at it from a personal financial perspective, everyone's like, oh, investing, yeah, I want stocks, bonds, mutual funds, et cetera. Well, it doesn't really do my pizzeria. Let's go back to my pizzeria first. My little pizzeria any good. It doesn't help me sell more pizza if I just happen to own shares of stock in other companies, right? That doesn't help me sell more pizza at all. So it's not really, it's an investing activity technically, but it's not the best way I should be investing. What I should be investing is in resources that are going to help me sell more pizza, because that's how I make a profit, right? As a pizzeria, that's how I make a profit. I sell pizzas. There's profit in the pizza. All right, it says profit pepperoni pizza. There's profit in there, believe it or not. And so what we're looking at for investing activities is businesses really need to be purchasing more assets. Assets it's another accounting term that you need to know. And assets are basically resources that are owned by the business. The purpose of the most assets is to help the business sell what it's selling. Okay, that's the purpose of most assets. That's the reason businesses own, stores and shelving and other types of things. Those assets help them sell stuff. Okay, and so those are the resources owned by business. That's a term you need to know. It's very, very good. So an investing activity might be, help getting our computer system up to date so we can perform more of what we're doing. Getting delivery trucks so we can deliver more goods and help us sell. Maybe update the furniture and fixtures in our stores. Maybe it's a restaurant, so we can fit more people in. People are more comfortable. They want to stay longer, and they'll order more food from us. Or we might need to purchase more and more buildings and keep expanding and opening up more and more stores. These are really, really good investing activities for a business, because they're saying this is how we're going to sell more of our product or provide more of our services. It is true that if they buy stock or other thing in another company, that is an investing activity. But again, the real investing activities that are meaningful are directly related to them selling more of their product or service. Okay, and last but not least, operating activities. Again, every company has hours of operation, which means they open at a certain time and they close at a certain time. So, what is happening during their operating activity? What type of activities are happening during their operating hours? Well, one thing for sure is they're able to sell their products or services, whatever they have for sale. And this is a very, very important term that you need to know too, revenue. Revenues are the amounts that are earned from selling a product or providing a service. So, for example, I showed you my little bottled water. If I went into a store to purchase that water and gave them $2 for that bottle of water, that $2 is their revenue for selling me the water. Okay. So wherever you go in, even if you're going into a doctor's office and you're paying, $100 to see the doctor, that's the revenue that the doctor is earning from providing the service. You go into a hairstyle place and you get your hair cut or styled, and you plop down, say $40. I'm making it up. Um, well, that $40 is the revenue for the hair salon because they cut your hair or styled your hair. You paid them $40. That's the revenue. That's the amount they earned from providing you the service. So that's a very, very important term. Matter of fact, I would say from a financial perspective, it's the most important thing you have to understand, because without any revenue for any organization, there is no organization. And a lot of students will tell me they want to start a business or they're interested in starting a business. And I think that's very good. We need more entrepreneurs. But my first question to them is always, okay, what are you going to sell? What do you have to offer? Again, you need to sell either a product or you need to sell a type of service. You have to do work for somebody. So we live in an economy that's more service oriented. So service revenue is earned by companies that perform services. And so you go to the doctor, you go to the lawyer, you go to a dentist, you go to an accountant to have your taxes done, you go to get your hair cut, you go to do other types of things. Those are mostly services. You're paying people to do work on your behalf. Um, and then you go to places like Walmart or Target or other stores in the mall and you buy products. So if you're buying products, that store looks at it as a sale. Sales are related to products. Okay. So, and everything that Walmart does is sales revenue because that's all that's in Walmart. They just have a bunch of products for sale and a whole bunch. So their revenue is tied up to that. Some businesses will have both sales revenue and service revenue because some businesses do both. So let's go back to the hairstylist. You might get a nice haircut, but then you want to also use the same type of shampoo, conditioner, and other things that the hairstylist used on you. So they might also sell you those products as well. So in that case, those stores are actually doing two things. They are generating sales revenue because they're selling you the shampoo, they're selling you, various things like this, but they're also providing the service by cutting your hair. So they're generating service revenue as well. Same thing if you have your oil change in your car, that's both sales revenue because you physically buying a product, the oil filter, things like that. But you're also paying for work. They're the ones who are going to drain it, clean it, put it back in, etc. for you. That's work that you're paying for. So revenue is really, really critical. It's also critical for those that are not in business, but have an organization like a nonprofit. Boys and girls clubs, YMCAs, they need to sell membership. That's their revenue streams. They have to sell membership. Churches sell membership too, believe it or not. This college is a nonprofit, like a lot of colleges are nonprofits. We also have needs. We need to sell things. We need to have something for sale, even though we're not a corporation. We sell courses, we sell certificates, we sell degree programs, right? So everybody needs regardless what you're doing, you need a revenue stream. So I cannot tell you anymore about how important revenue is to the life of any organization. Okay, let's move on. Another operating activity that happens is they're taking care of inventory. Now, remember, when you walk into a place like a Walmart or another favorite store of yours, there's already a bunch of stuff on the racks and on the shelves and so forth that are for sale. Well, they had to buy it first. Okay, the store literally had to buy that first and put it in the store. So that's their inventory. That's their inventory. So the inventory is basically the goods that are there available for sale to the customer. Okay, that's another very important uh, account in accounting that you will learn a lot more about. Here's another one that they put up here. This doesn't happen for you and me. You and I usually walk into a store and we usually pay, either we put cash down, we'll use our debit card or a credit card to buy things. But what you might not know is that even if we use a debit card or a credit card, our bank is forwarding the cash to the merchant that we just bought the stuff for. In the case of a credit card, you'll get a bill, but the merchant's not waiting for any money. The merchant got paid from the bank who issued you the card. However, uh, businesses do business with other businesses. So let's say my pizzeria needed an update on my computer system. I needed, so I went to Best Buy and I got their Geek Squad to put in a whole bunch of shit for me in my store, and now I'm all up to date. Well, because I'm a business dealing with another business, they might actually sell me everything and do the work and actually give me a bill. They might actually give me an invoice to pay. Um, so what Best Buy has done is they made a sale, but they're waiting to receive money on that sale. So that's what an accounts receivable is. They've already performed a service or provided a good, and they're waiting to get paid. So that's an accounts receivable. They're waiting to receive money on an account. Again, this only happens in business to business transactions. You and I are not going to be able to walk into a store and say, hey, yeah, just give me a bill, I'll pay you later. They'll call the cops. It's shoplifting, right? So, this is something that is a business to business specific thing that you're going to learn about. Another thing that happens during operations is not only are you generating revenue, which is your primary focus. The reason you're in business is to sell something. That's how your whole business is set up around whatever you're selling, whether it's a product or a service or both. That's the purpose of your business. And so, yes, revenue is very, very important. Selling stuff is very, very important. But you have costs. You have to actually spend money in order to help you sell the stuff you're doing. So those are expenses. So the costs of getting all that stuff done is what we consider an expense. So expenses, this is another general term that you need to know, like revenue. And there's lots of different expenses that businesses have. So businesses, for example, most businesses, don't own their buildings; they actually rent. And if you've been to any mall at any time, it's 100% rental. Okay, the malls are owned by separate real estate companies that rent out all the merchants that are in the mall. So that means every single month, every single store you see in the mall has a rent payment to make. That's a rent expense to them because they have to pay the rent to have their business to sell their stuff. Okay. All those companies usually have employees in which they have to pay to get the work done so the company can sell its good or service. So all the salaries and wages that they pay for employees become expenses to the business as well. So expenses are very numerous. You're going to learn a lot about those, particularly in the next learning objective, but it's very, very important that you become familiar with this. And then also during operating, some other liabilities do happen during operating activities that are not related to financing. For example, businesses might have bills to pay. So any bill that's due in the next 30 days, is an accounts payable. So for example, they might get an electric bill from the Central Hudson, say you owe $300, on February 15th. Okay, guess what? That's an accounts payable. Now we got a bill, it's due in 30 days, it's accounts payable. So those types of things do happen, and you're going to learn a lot about specific things that happen during operating activities. You probably know too that when you buy something, there are sales taxes. So most products are subject to a sales tax. So you go and you buy something, and they'll collect the price of the product plus tax. Well, that sales tax doesn't belong to them. They have to remit that to the state. So they have to set up a liability account called the sales taxes payable. So that's where all the sales taxes go. So they can send that over to the state. It's a liability because they owe it to the state. They're simply collecting it on behalf of the state. They do that with a lot of taxes. You'll be surprised. Okay. At the end of a particular period of time, usually every month, businesses really compare whether they compare their revenues and they compare their expenses. They look at those two and they say, this is the total of how much we sold, and this is the total of how much we needed to spend to sell all of that. If the revenues are bigger than the expenses, that's what a profit is. In accounting, a profit is net income. Okay. So the term net income is simply, in accounting, means it's a profit for that period of time. Again, they'll measure by periods of time, monthly for sure. The longest period of time they measure is a year, as you'll see. However, sometimes you'll go through a month or several months or a whole year where you're really not selling as much, but you still got a lot of expenses to pay. And so your expenses are bigger than your revenues. And sadly, this is what's happening, right? We're living through a pandemic where a lot of, say, restaurants, for example, they still have bills to pay. They still got to pay their rent. They still got to pay utilities. They still have to pay for everything else, their employees, for example. But the customers have gone away. They're not coming into the restaurant, sitting down, spending money anymore. So they have lower and lower revenue over time. In some cases, it's so dramatic that they're spending more to keep the business open than they're selling. And so when that happens, that's a net loss for a period of time. Okay. And so those are a few terms that you have to know about. And you're going to be seeing these terms over and over and over again. At the end of every objective, there's a do it exercise with solution. So let's take a look at the one here for learning objective 2, and I'll explain. They give you a whole bunch of stuff here, and they're going to ask you, how would you classify this? Is it an asset, which is a resource for a business, right? Is it a liability, which is a debt that the company owes? Is it common stock? Is it represent shares of ownership in the company? Is it revenue? Was it from something that they sold, right? They earned from selling something, or is an expense, a cost of that sale, right? So here's the cost of renting property. Rent is a regular expense for a business. Every month they're going to be paying rent. So here, rent is, as a matter of fact, it's actually a specific expense account you're going to be learning soon called rent expense. We have to label our expenses exactly what they are in accounting, as you'll see. The second thing here is we bought a truck. Well, a truck is something we're going to be using for a very long time in the company. It's a resource, so it's an asset. Okay, it's an asset. Here we had notes payable. Remember, we talked a little bit about notes. Every time you see the word note, it's a loan. Every time you see the word payable, you owe it. So it's a liability. Makes sense. You'll get used to this. This is the issuing. The word issue is selling ownership shares. So to sell ownership shares means you're selling common stock. You're selling ownership. Common stock represents common ownership. And the amount that you earn from providing a service or selling a product is what revenue is. These are the very important terms that you need to know in this part of the chapter. Okay, so we're back to our bigger screen, and I'm here to take questions.